Right now, I want to introduce Brenda. Sorry, gotta get my notes straight. Brenda has been with MNP for 16 years. After being with MNP for a number of years, she went back to school to get her degree while working full-time at MNP. She wrote her CPA exam in September of 2017 and passed. She works out of the MNP Brandon office and has been coming to Nipoash for the past couple of years. She was here at Big Idea last year. So welcome, Brenda.
Hi everyone, thanks for having me today. So I'm going to talk to you about a few things today. First of all, I just want to give some credit to the CPA Canada because a lot of my information I'm discussing with you today came from their sources and website. So we're going to talk about cash management, financing, managing risks, which is touched on both by Don and Andrew today. And then I'll have a closing question and answer period. So first we'll look at cash management. So cash management involves cash coming into your business and cash going out, and planning that and controlling the cash flow. Effective cash management can help you survive during our challenging times, which we've been experiencing the last several years. Budgets and forecasts will help you with cash management. So when discussing cash management, budgets and forecasts will provide you an opportunity to learn from differences in forecasts, analyzing why there are differences so you can learn from that and improve. Changes to cash come from external sources, so it's basically looking at your bank statement and things that are going into your bank and coming out of the bank. Therefore, it's important to pay close attention to what's going into and then out of your bank account and monitoring it frequently. Owners and managers intuitively know that cash is very important to their business, and they like to sign all the checks and see all of the deposits. And if you watch your cash closely, you can have a fairly accurate view of what's really going on in your business. You should do monthly reporting that compares your actual results to what you expected, so what your budgets had set. This even helps with smaller companies. Writing down reasons for why you have variances helps not only your staff, but you when you're sitting down with management, investors, or bankers to discuss your business and help them understand your business. So there's different approaches to cash management and forecasting your cash. It depends on the type of goals that you have. So for shorter term goals, you want to ensure that there's enough cash in your business for the day-to-day transactions as well as the next month. If you see a problem or you expect that there may be a problem, you'll want to talk to your banker about arranging an overdraft line or a line of credit. You don't want to wait till there's an actual problem. You want to be proactive and get ahead of it and have the conversations early. For medium and longer term goal plans, you're looking at cash requirements for the next quarter, the next year, and even several years into the future, especially if you're looking at capital expenditures to help expand your business. Cash available over longer periods of time depends on your operating results. So if you're having income, whether you're collecting your receivables from your customers, your disbursements to your suppliers, and many, many other factors, some of which you can control, some of which you can't. There's two different methods to monitor your cash flow. So there's the direct and the indirect method. The direct method is used for your short-term forecasting. It ignores any timing differences with regards to your accrual, so your accounts receivable, money coming in from your customers. It's based on your forecasted receipts and disbursements. So the cash balance you come up, your forecasted cash balance will not match your bank statement cash balance because you're dealing with what your forecasted receipts are going to be. Businesses want to avoid any bounced checks or payroll transfers being disallowed because they don't have enough money in their account. So the short-term forecasts allow you to keep ahead of those types of things, and again, arrange for anything with your banker, a line of credit or whatever, if you need to ahead of time. The indirect method is used for medium or longer term goals. So it starts with your accrued net income on your financial statements, and then you would subtract or add any non-cash items. So your financial statements may include depreciation on your equipment, and that would be a non-cash item, so you would take that out of the calculation to come to your cash number. Got ahead of myself there. One of the strengths of the indirect method of preparing cash flow forecasts is that they can be derived from the forecasted financial statements. Owners and owner managers are usually more comfortable forecasting their sales and their expenses as opposed to cash disbursements and receipts. So the indirect method usually provides a more accurate analysis. No forecasting, of course, is completely accurate. So you really do want to make sure that you compare what you budgeted for to your actual and find out why there's a difference or a discrepancy. You may have to correct things. It may include improving operations, but it could be as simple as changing your forecasting process so that it's more accurate going forward. When analyzing cash flows, you also should look for trends. So perhaps your business has historically shown lower accounts payable than what you budgeted for. This just could be because your staff are paying your suppliers a little bit too early. So if your terms are net 30 days, maybe they're paying them after 10 days or something like that. So I do have a planning and monitoring cash checklist handout with me today, so if you're interested in that, you can talk to me after the presentation and I can provide that with you. So now we'll start looking at financing. So there are 4 preliminary steps to understanding and obtaining financing. They all require you to see your business from the perspective of the lender. So you'll need to understand the 5 C's. Define and analyze your market, prepare reasonable forecasts outlining required finances and projected cash flows, and develop a written business plan, which Andrew went into depth on earlier. So the 5 C's of credit, they include character, capacity, collateral, and conditions and capital. So lenders have a checklist that they go through and they use these steps to analyze a prospective borrower. So when they're looking at character, they're going to look at the character of the owner and the manager and their confidence in the management of the business and whether the funds are going to be used, the use of the funds based on the previous experience with the owner and management. For capacity, they'll look at whether the business is able to meet the terms and conditions of the financing based on its profits and its cash flows. So for example, you may be able to get a $2 million loan, 5-year loan. On one end of the spectrum, you may be required to make principal and interest payments monthly, so at the end of the term, you don't owe anything. The other extreme would be maybe it's an interest-only loan, so you're only paying interest monthly, and then at the end of that 5-year term, you have to pay back the principal. So the bank will look at those different types of things and what suits your needs. Collateral, so the assets that you have available for collateral. If assets are already being used for a particular loan, they won't be available for a later loan until that first loan is paid off. They'll look at conditions, so both the economic conditions and the current conditions for your specific industry. They'll look at the capital, so the amounts invested by the owners themselves in relation to business risk and profitability. So they can determine how much risk they may have to assume by lending you money. So the next step to obtaining financing is to define and analyze your market. So before approaching a potential lender, you'll want to thoroughly understand your market. The business plan Andrew talked about will have a great deal of this information already in it. So you want to know who your potential customers are, where they're located, why they buy, when they buy, and their expectation in terms of price and quality and service. You want to explain the size of your market and the potential opportunity for growth, both in the short, medium, and long term, so 1 to 10 years or even more. You want to support the growth estimates with industry trends, technological developments, and changing customer needs. You need to clearly state the sources of your data and the assumptions that you use, and you must be realistic with your assumptions, which Andrew touched on as well. You don't want to overstate the size of your market or your potential share of that market. If you do that, it'll cast doubt on yourself and the credibility of your entire business plan. You want to describe your customers both by name, size, and location, and how their product or service compares with yours with regards to price and other factors. You need to assess your competitors' strengths and weaknesses in areas such as management, marketing, and financing. Next, for forecasts, you want to talk about what's expected to happen if certain events unfold. Lenders want to see realistic cash flow forecasts, which requires both forecasting your balance sheet as well as your income statement. You want to analyze what went wrong with previous forecasts and assumptions that didn't end up happening and why. For example, with the pandemic in the last few years, sales volumes have declined, but fixed costs relatively has stayed the same. So your property taxes, your rent. The last step to obtaining finances is to prepare the business plan. So it's a concise written description of the business and its overall activities, including products and production techniques, marketing and marketing strategy, management and personnel, sources and uses of funds, and financing needs. It should highlight both the past, present, and the future, and be well prepared. And if it is well prepared, it's a crucial part of the lending application. The business plan helps to force management to plan and monitor and assess the company's progress, and it allows management to think ahead and anticipate change. Your business plan will include details as to your target market and the forecast both your balance sheet and income statement, which we've previously discussed. In the early stages, when a business first starts up, banks tend not to lend money, and businesses usually have to seek other sources of financing. Then once operations stabilize, it's able to typically get debt financing. I'm going to briefly go over some options, but I also have a handout with more detailed handout with the types and sources of financing that are available. So if you're financing for current assets, you can apply for operating loans from banks, credit unions, and other lenders. If you're purchasing fixed assets, you can look at term loans, mortgages, equipment loans, both at banks, lenders, or BDC. To finance accounts payable, you can look at trade credit and negotiate payment terms with your suppliers, or you can look at government programs. The last source of financing would be contributions from yourself as owners or venture capitalists. So now we'll flip over to look at some numbers that bankers will typically look at certain ratios before giving you a loan. So a few of them are listed here. So we have debt to equity. So banks may lend up to 2 or 3 times the amount of equity, depending on the business. So again, the equity is what you basically have contributed to the company or your earnings that have grown over time. Your debt servicing, so your operating income must be 2.5 times the sum of any interest or principal payments that you have to repay or you're required to repay. Your break-even analysis, so that's the level of sales, units of sales that you need to cover your overhead expenses. So basically calculated by taking your total fixed costs, so your rent, your property taxes, by the sales per unit minus variable costs, so your raw materials or your commission per unit. Ratio of current assets to current liabilities. So it basically measures your ability to pay your current liabilities with your current assets. It's simply calculated by dividing the current assets by the current liabilities. And the desirable number for that is over 1. It's greater than 1. So we'll talk a little bit about managing risk, which has kind of already been talked about a couple times. But risk management starts with just a simple question: what are the major risks that are going to stop you from achieving your objectives? There are different components to risk management. You need to understand the environment that your company operates in, and you need to look at both the internal and the external factors. So external factors would include industry regulations, customers and stakeholders, expectations, and competitor and economic pressures. And our internal factors would include like our governance structure, culture, and strategic objectives. When you're looking at the external internal factors, you need to consider various things like risk identification. So you need to identify all the risks that could impact your company and prevent you from achieving your objectives. You need to do a risk assessment and prioritize your risks. So you want to estimate the impact of the risk happening and the likelihood that it'll actually happen. You need to decide how you're going to respond to your risk. So you look at whether you want to control the risk to minimize its impact or the likelihood of it occurring, whether you want to accept that risk, whether you want to avoid the risk by not pursuing the underlying objective, or whether you want to transfer the risk. So one way to transfer risk would be insurance. You need to monitor the risk on an ongoing basis to ensure that they don't become an unacceptable level of risk, and make sure that your controls to keep them at an acceptable level are operating. You also want to review the changing environment for any new risks that are coming your way, and report all risks to the stakeholders of the company. So don't forget, you want to build a team of trusted advisors, an accountant, a banker, a lawyer. Accountants can also help assist with tax planning. So I've kind of done up a quick example here today. So the chart on the screen is our 2022 Manitoba tax rates. So for the second tax bracket, it goes from $10,046 to $14,398 with a tax rate of 10.8%. And the next tax bracket is $14,399 to $34,431 with a tax rate of 25.8%. So basically any dollar earned over $14,398 is going to be taxed at 25.8%. So my example will be slightly out because I'm just going to use 25.8% to keep it simple and easy today. So if your business made $25,000 at the end of the day, we times that by our 25.8%, you would owe tax of $6,450. So you would also have to pay CPP on any business income earned because you're not an employee and you're not getting a paycheck where CPP is deducted off your paycheck. You do have to pay the CPP come tax time. So CPP rate for 2022 is 5.7%. So on top of the $6,450, you would actually also have to pay CPP of about $2,450. So total tax bill come April of $8,900. So if you had talked to an accountant, they may suggest purchasing RSPs to reduce your taxable income and reduce the tax owing. So in my example here, it would reduce it to $5,160. So you would save a little bit, you wouldn't have to pay as much to the government, and then you would start putting money away for retirement as well on top of that. So the sooner you can have these kind of discussions with your accountant, the better. Another thing that could be suggested too, if RSPs are not an option for cash flow reasons, you can also just start putting money away every month too, right? So that it's not such a big amount to pay all at once in April. So there's different strategies, so the sooner you can talk to someone, the better. Does anyone have any questions? And I am going to be here all day too, so if you're not comfortable in a big setting asking questions, you can ask. Yeah?
Those numbers from which you have the deductions, those are net, correct?
Yes, they are. Yeah. So after expenses. Good question.
Is this for a personal or?
This is personal,
Yeah.
so it would be different if you're incorporated. Yeah. questions? No?
What would you tell an entrepreneur who's starting out as starting a business? Do they need to incorporate right away, or should
No.
they stay as a sole prop?
No, until you're earning significant revenue and you're not using most of what you're earning to live off of, yeah, incorporation doesn't make sense. It is quite expensive to incorporate, so we would have to look at the specific situation and make sure it made sense for that individual. Yeah. Good questions. Last year I didn't get any. Any other?
Is it true with up to a certain, again, kind of sole proprietor, going up to a certain amount that they make each year that you have to pay taxes in installments rather at one lump sum at the
Yeah.
equal deadline?
Yeah, so if you make over $3,000 for more than 2 or 3 years in a row, they will require you to make installments, yeah.
Okay.
Now, if you figure that next year your income is gonna be lower than that and you're not gonna actually end up owing any tax, then you can choose not to make your installments. But then if you do end up owing at the end of the day, they will charge you interest for not paying installments, so,
For sure.
yeah.
And I guess another number to keep in mind is if you make more than 10,000, having to pay RST, and then having to pay, is it 30,000, then it's GST, right?
Yeah, over 30,000, yeah,
Yeah.
then you're required to register for GST. Yep,
Taxes add up.
yep.
With entrepreneurs that are projected to make more than 30,000, do you recommend them registering for their GST right from the beginning and keeping track? Or does that just start then from once they hit 30,000 at that point? Like, does it backdate? Like, are they going to be required to backpay?
No.
Or it just starts?
No,
like
it just starts
30,000
when they
when-
start making over
Okay,
30,000,
so
yeah.
when do you recommend them registering for their GST?
I wouldn't do it any earlier than I had to, unless, it may be different if you're a farmer.
Yeah.
Because they don't typically collect GST, but they can get their GST back on purchases.
Okay.
Because they're zero rated for GST. So for them, I'd probably give different advice, but yeah.
So when you mentioned farmer, does that also include other types of ag businesses? For instance, like somebody who does small scale flower farming versus traditional farming?
Yeah, so even like greenhouses, that type of thing, bees as well. Yeah.
Okay,
Yeah,
thank you.
you're welcome. Anything else? Go ahead.
What tend to be some of the more beneficial, in your experience, tax credits? Is it more in terms of if you get into having a property? Is it the innovation credits? What sort of helps reduce that overall tax bill for a lot of businesses in your experience?
I would say probably most of them are more personal tax credits as opposed to relating to the business. Because your business is, except for farmers, are done on an accrual basis as well. Or you pay tax on the accrual basis. But there are different personal tax credits that could, depending on the person's individual situation, that could help. Yeah, go ahead.
I'm asking all questions entrepreneurs ask us.
When somebody has a part-time business and like a home-based business, at what point do they need to start really keeping track and paying tax on it? Like, for instance, if I started a home-based business, maybe my kid's really into slime. Maybe we start selling slime. At what point do I need to start keeping track of my sales
So I
to
would think-
report them?
I would think if it's expected that you're gonna make money from the business, that you would start it
Right.
immediately. But there are like the home-based businesses, like if we're talking like, I don't know, Creative Memories or Mary Kay or those types
Oh,
of
like
things.
MLMs.
Yeah, so
Okay.
if you're, like, most of those people that are in business and they do that, they don't typically make money. There's usually a loss from year to year.
Mhm.
So the government may look at that and think of it as a hobby, not a
Right,
business.
so don't
So-
claim things thinking that you are a business, because then you do get audited. I learned that, because I But I'm just thinking about our entrepreneurs that might have a side hustle, who then are looking at expanding it, coming to Futurepreneur. At what point do they have to kind of start reporting things? Like when you say making money, does the CRA kind of have like a benchmark? Like,
Not really. I would say though, if they're in it to make money, then they should just be putting it on their tax return.
Okay.
Would be mine.
That's what I tell,
Yes.
that's what I tell my entrepreneurs
Yeah,
when they
what's the
come to
difference
me.
between a hobby and a side business?
I tell them to start tracking your business as if you're making 30,000, because when you get that busy, I always tell them, you're gonna look back and go, oh yeah, Marilyn said I should have looked after that.
So the earlier the better.
Yeah, earlier the better.
Yeah.
Just to create good habits for your business.
Yeah, and to ask the questions I know my kid is gonna ask me, does she have to start reporting? If you have someone under the age of 18 with a home-based business, making money.
Is she under, it depends if she's
She's
under the
8 years
basic
old.
personal insurance.
She's 8 years old and she made almost $1,000 selling flowers out of our backyard. Yeah.
So basically, she's under the basic personal exemption, but there is a spot on YouTube, on your return to record that as a dependent income so that it, for all your credits and stuff that you get.
Okay.
So yeah, it should just go on your return
All right.
as a dependent income.
I told her she has to pay mom.